Benjamin Graham's The Intelligent Investor unfolds as a practical meditation on how to approach money, risk, and ownership in a world full of noise, hype, and shifting tide. From the opening pages, Graham draws a bright line between investing and speculation, a distinction he treats as the book's through line. He notes that, historically, the word investor on Wall Street has often been misapplied to anyone who trades in stocks, a habit that erodes the sense of prudent, value-driven decision-making. An investment, in his definition, is an operation that, after thorough analysis, promises safety of principal and an adequate return. Everything else is speculation, some of it innocent, some of it dangerous. This framework becomes the compass by which every subsequent idea, tactic, and warning will be measured. The opening chapters remind readers that after the trauma of the 1929 to 1932 crash, public sentiment swung between viewing stocks as perilous risk and treating them as glittering, unstoppable bet. The central aim is to outline who should invest, how they should think about risk and return, and how to structure a portfolio that matches individual temperament, responsibilities, and life plans. Graham spends substantial time clarifying two archetypes: the defensive or conservative investor and the enterprising or aggressive investor. The defensive investor seeks safety, ease, and a reasonable return, achieved through a straightforward policy of diversification between high-grade bonds or cash equivalents and leading common stocks. He emphasizes that there's no expectation of spectacular gains from such a portfolio. The payoff comes through steady, risk-adjusted growth over time. He anchors this approach in the spirit of his earlier security analysis. Invest in vehicles whose safety and value can be demonstrated through careful analysis, and stay wary of hot issues, margin buying, and speculative froth. A practical baseline emerges: a 50-50 mix between bonds and stocks, with a broad tolerance allowing 25% to 75% in either component. Given the yield relationships of the era, the combined expected return from bonds and stocks hovers around 7.5% before taxes, roughly 5% after taxes. It's a modest target by post-war exuberance, but it aligns with the real risks of inflation, volatility, and capital preservation. Graham returns to the question of what results look like for the defensive investor in the real world. He traces the arc of expectations over a 6-year horizon and notes how higher interest rates have lifted bond prospective returns since the mid-1960s, while dividend yields on leading stocks lag behind. In late 1971 and early 1972, bonds present a compelling case for part of a conservative portfolio, but the economics do not justify an all-bond or all-stock posture given inflation's persistence and the unpredictability of cycles. The disciplined path remains: maintain a substantial bond-like component that cushions volatility while preserving meaningful equity exposure to hedge against inflation and to participate in growth over time. Turning to stocks, Graham warns the defensive investor away from chasing high-priced, growth plays or momentum bets that demand more skill than is realistically within reach. Instead, he advocates a diversified lineup of well-established firms with solid finances, long dividend histories, and conservative balance sheet. He offers a practical guardrail for price: roughly no more than 25 times the average earnings over the past 7 years, and no more than about 20 times the most recent 12 months' earnings. This guardrail rules out many glamour stocks, but, for Graham, it's a safeguard against the exuberance that has historically produced painful mispricings and corrections. He adds a simple discipline: dollar-cost averaging, especially when used alongside professional vehicles like mutual funds or index funds that reduce the burden of stock picking while preserving diversification. The enterprising investor, those looking for potentially higher returns, faces a more nuanced landscape. Graham concedes that there are pathways to outsized gains, but immediately lays down a cautionary framework. Aggressive investing should still begin with a solid core and only deviate where there is a well-considered rationale and a clear margin of safety. He argues against stock trading, against short-term market timing, and against over-reliance on hot new issues or growth fantasies. Instead, the enterprising route should pursue undervalued opportunities, special situations, and bargain issues where the price already discounts risk. He warns that special situations, arbitrages, workouts, and corporate reorganizations require real knowledge and a careful approach, since past profitability from such tactics has waxed and waned with markets and regulation. Graham then expands the conversation in Part 2, laying out a broad map of how investors should view price movements, market forecasts, and the psychology that trips up ordinary buyers. He makes a clear distinction. If you intend to speculate, do so with eyes open and away from your genuine investment program. The heart of his argument is that timing the market, trying to forecast prices, tends to lead to speculation and subpar long-run results, while prudent pricing, buying below intrinsic value and selling above it, can yield satisfactory outcomes for the defensive investor. He revisits two dominant approaches to market movements: timing, forecasts, and pricing, value-based decisions. Timing, though emotionally appealing, is practically unreliable for most investors. Pricing aligns with a long-run holding strategy and helps avoid the trap of constant gyrations. Graham also critiques widely used timing theories, such as Dow theory. He notes its historical usefulness largely before 1938 but points out its diminished value in more modern markets, using the example to illustrate a broader truth. As a forecasting tool grows in popularity, its practical value often erodes because the crowd's behavior shifts in response. Price swings, especially when observed over multi-year horizons, become less predictable. The classic maxim of buy low, sell high carries historical resonance, but Graham argues that the cyclical regularity of earlier eras has given way to more irregular patterns since the late 1940s. Rather than chasing bear market troughs or bull market peaks to time a policy, the prudent investor should adjust the stock or bond mix based on value judgments about price levels, not predictions about where markets will go next. A mechanical, rules-based approach to rebalancing, triggered by valuation signals rather than forecasts, offers a shield against the extremes of euphoria and panic. Central to this section is the belief that ownership of real businesses gives meaning to price fluctuations. Markets price stocks with a premium to tangible asset value when growth prospects are strong, which increases volatility relative to true intrinsic value. The IBM and Xerox examples aren't mere anecdotes. They illustrate how premium valuations can evaporate when growth expectations disappoint, even with solid underlying performance. The practical upshot is a preference for stocks priced near tangible asset value, coupled with durable earnings and financial strength. A mechanical policy for changing the stock-to-bond ratio helps channel energy into systematic reallocation rather than emotional trading. Graham's vision is a partnership with Mr. Market, a temperamental partner whose daily quotes should be used when convenient, but whose wisdom is not allowed to override long-term value. The investor should listen to Mr. Market's price quotes as signals, not as fate. Graham's discussion moves beyond individual stocks to the world of funds. In the chapter on investment funds, he surveys mutual funds and closed-end funds, acknowledging their growth and regulatory evolution while warning against performance funds that chase hot returns. The funnel of fund performance becomes a graphic reminder that most active funds fail to beat broad market indices over longer horizons. Indexing emerges as a practical, costs-aware route to diversification and predictable exposure to the market. The logic is simple. Low costs, broad exposure, and a long time horizon outperform the majority of active managers who chase short-term wins, charge high fees, and take on unintended risk. For many ordinary investors, the best path is to embrace a low-cost index fund as the core holding, with a cautious allowance for an additional allocation to specialist funds only after careful scrutiny of costs, ownership, and the strategy's ability to weather changing conditions. The conversation about advisors and guidance follows in Chapter 10. Graham argues that most investors lean on others for decision-making, but warns that normal advice should be limited to standard, conservative strategies unless the investor has reached a level of understanding that enables evaluating more complex proposals. He categorizes advisors into lines of service: investment counselors who work on a fee basis, forecasting services, and brokers who provide research and trading. Due diligence becomes essential. Check credentials, regulatory vetting, and potential conflicts of interest. The best advisors act as a line of defense against the investor's own impulses, helping maintain a disciplined plan, with a formal investment policy statement and asset allocation as core tools. The guiding principle remains: trust, then verify, and the relationship should be anchored in the investor's goals and tolerance for risk. Security analysis returns to the foreground in Part 2 as a disciplined practice. Graham distinguishes between safety tests for bonds and preferred stocks and the more intricate task of valuing common stock. Bond safety hinges on coverage: how many times earnings can cover fixed charges, while similar standards apply to preferreds. He notes that past performance in evaluating common stocks has given way to growth projections, sometimes aided by sophisticated mathematics that can misfire when future results diverge from historical patterns. The recommended approach is two-part. First, determine a past performance value using a standardized framework, then adjust that value for plausible future conditions. Industry forecasts carry caution. Technology's impact grows, but so does the risk of misplaced certainty. A disciplined process: senior analysts framing the broad view, juniors handling data, and senior judgment deciding how much to adjust, helps keep value separate from speculative forecasts. Earnings per share receive careful scrutiny in the next wave of analysis. The Alcoa example demonstrates how primary earnings, net income after charges, and dilution from convertible securities can distort the earnings picture. Footnotes, accounting methods, and the nuances of depreciation, revenue recognition, and stock option dilution all matter. Averages of earnings are recommended to smooth cyclical swings, and the perils of relying on a single year's result become clear. The aim is true earnings power and cash-generating ability, not the lure of a glossy year-end number. This thread, watch for non-recurring items and accounting tricks, winds through the following chapters, where 4 listed companies, Eltra, Emerson Electric, Emery Air Freight, and Emhart, are analyzed in a practical exercise that shows how price/earnings ratios can diverge from underlying performance. The lesson is consistent. Defensive investors should value durable fundamentals and avoid paying up for glamour or for growth that is not well supported by the business. Chapter 14 turns to stock selection for the defensive investor with 2 paths. A Dow Jones Industrial Average type basket offers breadth, while a quantitatively tested portfolio uses explicit criteria. Graham lays out 7 criteria tailored to defense: adequate company size, strong financial condition, earnings stability, uninterrupted dividends for at least 2 decades, earnings growth of at least 1/3 over 10 years, a moderate price/earnings ratio, roughly no more than 15 times average earnings over the past 3 years, and a conservative price-to-asset ratio, no more than 1.5x book. He notes that these criteria inevitably exclude many stocks, especially in difficult times, and that diversification is the antidote to single-name risk. The DJIA Group often meets these criteria, while public utilities and railroads present their own opportunities and hazard. Diversification and a disciplined approach, not glamorous narratives, are the keys to resilience, even when opportunities look sparse. Graham ends Part 2 with a practical apotheosis. For defensive investors, the most reliable path is broad diversification through a total stock market index fund, complemented by a core allocation in high-grade bonds. If stock picking is pursued, no more than 10% of equities should be devoted to speculative experiments, with the remainder anchored by low-cost, broad market exposure. He returns to his core exhortation: diversification is the safest way to reduce risk and avoid the painful consequences of concentrated bet. Understanding why diversification matters, and why it protects against human tendencies toward overhyped opportunities, becomes central. The closing note of this part is a reaffirmation that the path to solid, long-term results lies in humility, patience, and discipline, the guardrails that separate intelligent investing from the seductive but unreliable world of speculation. Part 2, in effect, ties together a theory and a practice that emphasize price-based, value-oriented decisions. It also supplies a practical toolkit: fund selection, advisor diligence, and disciplined stock picking for a resilient, long-term portfolio. The through line: timing is usually a fool's game. Value-based pricing guided by a margin of safety is the prudent course, remains Graham's core message. Part 4 broadens Graham's warnings, returning to the heart of his critics' concern: the seduction of modern growth fantasies and the external pressures of analysts and elaborate valuation models. The central tension is between price and value in a world fixated on growth. Graham shows that as firms become more complex and their intangible assets grow, a large portion of value can exist in futures and expectations rather than in tangible asset. The market's willingness to assign enormous multipliers to growth can justify lofty valuations only if those growth assumptions prove sustainable. When they don't, prices collapse. The essence, for Graham, is that the margin of safety remains the antidote to speculative excess. The more elaborate the mathematics, the likelier the analyst substitutes theory for experience and blurs the line between investment and speculation. He argues against treating sophisticated models as substitutes for real understanding of a business, and he cautions that tangible assets can be a drag on value if the market overvalues growth prospects, while undervalued real assets do not automatically guarantee safety if the price paid ignores prudent appraisal of value. Graham's cautionary narratives: Aetna Maintenance Company becoming Hayden's switch and instrument, NVF's Sharon Steel acquisition, and the broader tech surge of the era, exemplify how accounting tricks and growth fantasies can misprice risk. He shows that hundreds of technology names, abundant in early 1970s markets, were unprofitable or paid little in dividends, and many offerings rode momentum rather than durable economic. The contrast with IBM's earnings-anchored growth underscores a crucial point. Market direction can diverge sharply from fundamentals, and investors must stay vigilant when confronted with hot groups of new issues. The overarching message is clear: avoid the lure of unpredictable forecasts, resist chasing glamorous but fragile growth stories, and insist on a genuine margin of safety. The investor's success, Graham argues, comes not from outguessing the market but from disciplined evaluation of value, prudent diversification, and a readiness to act in the middle ground, where high-quality, reasonably priced stocks reside and where risk is protected by a substantial cushion against error. The tone across these parts is practical, ironical, and warmly admonitory. Graham's stories: the IBM water metaphor about value lying behind a changing facade, the caution against over-reliance on complex math, function not as mere anecdotes but as demonstrations of how markets misprice risk and opportunity in ways a careful reader can correct, provided they keep a steady focus on the margin of safety and a sober view of value. The closing cadence invites readers to embrace a steady, cautious rhythm, to invest with a prudent posture that accepts imperfection in markets, that tests ideas against fundamentals, and that remains anchored in a long-term horizon rather than episodic fads or spectacular but unstable promises. In the end, Graham's synthesis is as practical as it is moral. The Intelligent Investor is a primer on restraint and discernment. It asks readers to know themselves, how much risk they can bear, what obligations they must meet, and how to structure a portfolio that can endure the inevitable ebbs and flows of markets. The book makes a stark case that the margin of safety is not a relic of the past but a living standard, an essential counterweight to speculative mania in any era. It encourages a mindset that prizes patience, humility, and disciplined execution over clever forecasts or dazzling models. The true path to successful investing, Graham insists, lies in the quiet work of analyzing, diversifying, and sticking to a plan that respects value more than hype. It is a call to build wealth not through dramatic acts of genius but through a careful, methodical, and humane approach to owning businesses over time.